Did you know that in cities like San Francisco, top earners can face tax rates as high as 67%? That's over 2/3 of their income going to taxes. In this video, we'll reveal how the wealthy use real estate investments to reduce their tax burden. Let's get started and unlock these tax-saving secrets. 1. Own properties in a self-directed IRA. A self-directed IRA is a retirement account that lets you invest in real estate, not just stocks and bonds. It's a way to diversify your retirement savings and can include property investments. Suppose you use $200,000 from your self-directed IRA to buy a rental property. Over time, this property appreciates to $300,000 and also generates rental income, all growing tax-deferred within your IRA. How to do it? Open a self-directed IRA with a custodian that offers real estate investments. Transfer funds from an existing IRA or make new contributions. Invest in real estate strictly for investment purposes. Manage properly while following IRS rules, like paying all expenses from the IRA and not using the property personally. Stay compliant with tax regulations, especially if the property is financed. 2. Depreciate your properties. Depreciation in real estate is a tax deduction that allows you to recover the cost of an income-generating property over time. It acknowledges that properties wear out, get used up, or become obsolete. Imagine you buy an investment property for $300,000. Residential properties are typically depreciated over 27.5 years. So each year, you can deduct about $10,909, $300,000 divided by 27.5, from your taxable income as depreciation. How to do it? Determine the property's basis. This is usually the purchase price. Separate land and building value. You can only depreciate the building, not the land. Calculate annual depreciation. Divide the building value by 27.5 years for residential properties, or 39 years for commercial. Claim the deduction annually. Report this depreciation each year on your tax return to reduce taxable income from the property. 3. Write off all your travel expenses. Writing off travel expenses allows real estate investors to deduct costs related to traveling for their investment activities. This can include visiting properties, meeting with agents, or other travel directly related to managing your investment. Say you travel to a city 200 miles away to view potential investment properties. You spend $150 on gas, $200 on lodging, and $100 on meals. These expenses, totaling $450, can be deducted from your taxable income as long as they're solely for investment purposes. How to do it? Track your expenses. Keep detailed records of all travel expenses, including mileage, lodging, meals, and any other costs directly related to your real estate investment activities. Ensure purpose of travel. The primary purpose of the trip should be for your real estate business, not personal. File appropriately. Report these expenses on your tax return in the section for business expenses related to your real estate activities. 4. Deduct home office and business equipment. This deduction allows real estate investors to write off expenses related to a home office and business equipment if they are actively managing their investments. The home office must be used regularly and exclusively for business. Suppose you use a room in your home, 10% of your home's total space, as an office for your real estate activities. Your annual home expenses, mortgage interest, insurance, utilities, total $12,000. You can deduct 10% of these expenses, amounting to $1,200 as a home office deduction. Additionally, if you buy a laptop for $1,000 and a printer for $300 for business use, you can deduct these costs too, totaling $1,300. How to do it? Determine the office space. Measure the area used exclusively for business in your home. Calculate percentage of home used. Calculate the percentage of your home's total area used for the office. Total home expenses. Add up all home-related expenses, utilities, insurance, mortgage interest, etc. Apply percentage. Apply the percentage to your total home expenses to determine your deduction. Include business equipment. Keep receipts and records for business equipment purchases and deduct these costs. 5. Take the 20% pass-through deduction. The 20% pass-through deduction, established under the Tax Cuts and Jobs Act, allows real estate investors who operate as sole proprietors, LLCs, or partnerships to deduct up to 20% of their net rental income from their taxes. This deduction effectively reduces the amount of income subject to taxation. If your rental properties generate a net income of $50,000 in a year, you may qualify to deduct 20% of this amount, which is $10,000, from your taxable income. This means you'll only be taxed on $40,000 of your rental income. How to do it. Determine eligibility. Confirm that your real estate business qualifies for the deduction. Generally, it applies to sole proprietors, LLCs, partnerships, and S corporations. Calculate net rental income. Deduct all allowable expenses from your rental income to find the net income. Apply the 20% rule. Calculate 20% of your net rental income. Claim the deduction. Report this deduction on your tax return to reduce your taxable rental income. 6. 1031 exchanges to defer capital gains taxes. A 1031 exchange, named after Section 1031 of the IRS Code, allows real estate investors to defer paying capital gains taxes when they sell an investment property and reinvest the proceeds in another property. This process must follow specific rules set by the IRS. You sell a rental property for $300,000, which you originally bought for $200,000, realizing a gain of $100,000. Instead of paying capital gains tax on this $100,000, you use a 1031 exchange to buy another property worth $300,000 or more. By doing this, you defer paying taxes on the $100,000 gain until you sell the new property. How to do it. Sell your property. Begin by selling your investment property. Identify replacement property. Within 45 days of the sale, identify up to 3 potential replacement properties. Complete the purchase. You have 180 days from the sale of the original property to close on one of the identified properties. Use a qualified intermediary. The proceeds from the sale must be held by a qualified intermediary and not received by you directly. Follow IRS rules. Ensure the replacement property is of equal or greater value and is used for a similar purpose, investment or business. 7. Never sell, just refinance. The strategy of never sell, just refinance involves keeping your investment properties and refinancing them instead of selling. This allows you to access the property's equity as cash without incurring capital gains taxes, which typically apply when you sell a property for profit. You buy a property for $200,000. Over time, its value increases to $300,000, creating $100,000 in equity. Instead of selling the property and paying capital gains tax on this $100,000 profit, you refinance the property, taking out a new mortgage for a higher amount based on its increased value. This way, you get cash from the refinanced loan, say $100,000, and you still own the property. How to do it? Build equity. Wait for your property to appreciate in value and/or pay down the mortgage to build equity. Apply for refinancing. Approach a lender to refinance your property based on its current market value. Get a new mortgage. Secure a new mortgage that is larger than your existing one. Receive the difference in cash. The difference between the new mortgage and the remaining amount of the old mortgage is given to you as cash. Continue to own the property. You keep the property, continuing to earn rental income and benefiting from further appreciation. 8. Realize appreciation by borrowing, not selling. This strategy involves borrowing against the increased value of your investment property instead of selling it. By doing so, you can access the equity without paying capital gains taxes, which would be due upon sale. You purchase a property for $200,000. Over the years, its value appreciates to $300,000, creating $100,000 in equity. Rather than selling the property and facing capital gains tax on the $100,000 increase, you obtain a loan using the property as collateral. This loan provides you with cash up to the amount of the appreciated equity, in this case, potentially $100,000. How to do it? Wait for appreciation. Allow your property to increase in value over time. Apply for a loan. Approach a bank or financial institution for a loan or a home equity line of credit, HELOC, against the property. Use property as collateral. Secure the loan using the property's equity as collateral. Receive loan amount. Get the cash equivalent to the appreciated value or a portion of it. Retain ownership. Continue owning and managing the property, which may further appreciate in value. 9. Die owning your properties. The concept of die owning your properties involves holding on to your investment properties until your death, at which point they are passed on to your heirs. This strategy can be advantageous for tax purposes, as it allows for a step-up in basis, potentially reducing capital gains taxes for the heirs. You buy a property for $200,000, and over the years its value appreciates to $500,000. If you were to sell the property while alive, you'd owe capital gains tax on the $300,000 profit. However, if you hold on to the property until death, your heirs inherit it at its current market value of $500,000. If they sell it at this price, there's no capital gain from the time they inherited it, thus no capital gains tax. How to do it? Invest in real estate. Acquire and manage investment properties. Hold on to properties. Instead of selling, keep the properties throughout your lifetime. Estate planning. Include these properties in your estate plan, specifying how they should be handled or distributed upon your death. Benefit from step-up in basis. Upon your death, the property's tax basis is stepped up to their current market value, reducing potential capital gains taxes for your heirs. Here is a gift for you. We offer a free consultation with our expert tax professionals. To book your free session and gain valuable insights tailored to your situation, simply click the link in the video description. Don't miss this opportunity for expert guidance. If you found this information helpful, please show your support by liking, subscribing, and sharing this video. Your engagement helps us reach and assist more people. Don't forget to drop your thoughts and questions in the comments below. We love hearing from you.